Hey everyone, welcome in to another daily editorial here on the KE Report. I'm chatting with Marc Chandler on another of our special Sunday daily editorials. We're going to take a look back through this last week with some of the key data points, central bank meetings, but really the focus being on next week, this week coming up that has a lot going on in the US and actually a lot of G10 central banks meeting as well. Marc is the managing partner at Bannockburn Global ForEx, also editor of the Mark to Market website, which I will link to in the show notes. Marc, this week was jobs data on Friday, Bank of Japan and the Bank of England budget that was released. Look, the jobs data came out on Friday and it was broadly weak. I think expectations were for it to be weak, but it was even weaker than estimates and a large revision to the last 2 months of over 110,000 jobs. Let's start with the jobs data real quick. Marc, your takeaway, please.
Yeah, sure. So I think people recognize that this jobs report is not really clean in the sense that there were two hurricanes, there was a Boeing strike, there were some other temporary portions. So when the BLS, that's the Bureau of Labor Statistics, who issues this, the jobs report, they said that these events probably distorted the non-farm payroll number, the jobs creation, but probably didn't have much impact on the unemployment rate, which stayed at 4.1%. At the end of the day, I don't think that the data is going to move anybody's needle. It's not clean enough. And by not moving anybody's needle, I mean that if we would have had this kind of 12,000 growth in non-farm payrolls, a downward revision of 112,000, a loss of 46,000 in manufacturing, if those numbers were really to be taken at face value, that's what I mean by changing the needle. That I think people are looking through that, and what that means specifically is that the Federal Reserve is still going to cut rates 25 basis points next week. The market is very confident, and by very confident, I mean more than 90% confident that the Fed's going to cut next week 25 basis points. And it's despite we had a GDP number earlier this week as well, and we had a 2.8% growth, another quarter in the U.S. of above trend growth. Taking this all into account, the market still says that there's better than an 80% chance the Fed cuts rates again in December. So I know that the talk had been that stronger economic data, many of the large pools of capital at different conferences have expressed skepticism about a December rate cut, but the market still has it largely discounted.
Well, we know how those expectations can change, but at least right now, look, we'll talk about what the Fed is probably going to do next week, even though a lot of people are saying they won't because of the election. But when we look at this jobs data, Marc, the one thing that stays true is it is volatile. You get 1 month of blowout jobs, the next month of almost no jobs. And yes, we can point to individual factors, but I think the important aspect is to look at the 3, 6, 12-month averages of jobs. Do you have any data for us on those, on that front, in terms of where the trend is for job creation?
Yeah, sure. And I think you're right that, when it comes to a lot of this like high frequency economic data, it tends to be noisy. And I know that there's this, I say this, we're getting close to the US election. So there's all this talk about like deep state and conspiracy type things. But I think that one aspect that tends not to be fully understood by a lot of participants is that when they do the survey, when the BLS does the survey, what does this mean? It means they call up a lot of businesses, the establishment survey. But what if the businesses don't respond so much? And that's what we've really seen happen is that the responses from the establishments, from the businesses, have been falling. And so that requires then these revisions because then the BLS is relying on other sources to help confirm the economic data that they're not getting from the establishments. So I wouldn't think of a deep state. I wouldn't think of it necessarily become more volatile. I think maybe the lack of participation is a big role here. But yeah, to your point on the trends, in the 12 months here through October, it's 181,000. Last October it was 245,000. That captures the gradual slowdown. In the last 3 months, though, remember the average, given these downward revisions, 3 months, 104,000. Again, the 12-month moving average, 181,000. So you can see 3 months lower than the 12 month, and the 3 month is lower than the 6 month as well. Taken as a whole, I'd say that the trend is still lower. And I think that the other point I'd make about the jobs data is that When it comes to the Fed has, as you know, a dual mandate, full employment, price stability. When it comes to price stability, Powell says there's one number that captures price stability for the Federal Reserve, and that's the PCE deflator, the headline PCE deflator. But says when it comes to the labor market, there's not just one number that captures it, multidimensional. And so I think when we look at the broad range of labor market data, I think that's still consistent with a gradual slowing in the labor market, which means that the level of restriction of monetary policy might not be needed. And so despite the faster growth, the slowing down in the labor market might allow the Federal Reserve to continue to cut interest rates, not just this year, but next year as well.
Do you think we need to be concerned about the labor market? I realize it's slowing, but is it slowing to an extent that this is concerning in your eyes?
Well, I don't think it's concerned, but I do think that, and Powell said something like, we're content with the current, like the slowing that has happened. We don't want it to slow down further. And so I think that it's important then in order to sustain or to extend the soft landing, it's important that the labor market doesn't continue to slow. And so I say it hasn't reached a point of significant concern yet, but it's clear that the Federal Reserve has shifted from the inflation as the biggest worry to the labor market being more concerning.
Let's also talk about some of the other news real quick. Bank of Japan on hold with any rate moves. Bank of England released their budget. Of course, we're seeing deficits. That seems to be a consistent trend of any budgets coming out of any country right now. But Mark, your takeaway from those two news events from last week.
So you're right about the Bank of Japan. It held fast, not raising interest rates. I think that given all that turmoil that looks like was sparked by when they hiked rates in July, that they're going to really prepare the markets for the next move. The market's got a little bit more than, say, 8 basis points priced in for December, which might be half of a 15 basis point move. I think most economists now look for it to come for the next rate hike, that is, from the Bank of Japan to come early next year. Turning just quickly to the UK, it's not so much the Bank of England, which will meet next week and cut rates, but it's really the new Labour government that gave us their first budget. And the first budget, there weren't a lot of surprises in it, but it did call for, as one might have expected, higher taxes, more spending, more borrowing. And the markets didn't really like this very much. I'll put this in perspective for you. The 10-year US Treasury yield rose about 6 basis points last week. The UK 10-year gilt rose almost 19 basis points net on the week. And sterling suffered. Sterling fell to new 3-month lows before recovering a bit. The market, I think, was recognizing, and the same thing that's happened perhaps in the U.S. as well. The talk among the large pools of capital was that it might not make much of a difference in the U.S. election outcome because both candidates would have a larger budget deficit, more debt, greater supply of treasuries, therefore higher yields. Well, in the UK, they're also going to have greater supply of gilts than the market had anticipated. And in order to offset that added supply, you need a lower price, which means the higher yields. So I think that the market's still going to be pressing labor on this. And so I could see somewhat higher yields in the coming days. But the Bank of England, though, is still set to cut interest rates in this coming week, same day as the Federal Reserve, a little bit before the Federal Reserve. Remember what happened last time? They said that they cut rates before, that is to say, the Bank of England cut rates before they knew how the Fed was going to vote. And remember in September, the Fed cut 50 basis points. I think it's just interesting, that once again, a couple of years ago, people were concerned about a short-term prime minister in the UK trust, an unfunded deficit, led to a big gilt sell-off. This time we've had, I should say back then, it was about a 100 basis point increase in the 10-year yield. And now I think maybe we've gotten 30 basis points or so from the high to the low since the budget.
Mark, make sense of these market moves then to end this week and even on Thursday. We are recording this on Friday, but Thursday there is a big drop in the market to end the month of October. And even today on Friday, look, the weaker jobs data, we are seeing yields continue to move up. Markets are also moving up. And the dollar this month has been on an absolute tear. For the first 3 weeks of that month, the dollar was up pretty much 4%. That's a big move for the major currency like the dollar. Make sense of these market moves then, Mark. How are you seeing investors position?
Yeah, huh? I mean, isn't this the hard thing right now? I mean, trying to like find a common narrative to this. And what's interesting too about your point about the dollar is the dollar index rose 4 consecutive weeks in September. Excuse me, I should say the opposite way around. The dollar index fell 4 consecutive weeks in September, rose 4 consecutive weeks in October, and this week, like you mentioned this last week, it's basically flat, down about zero point 0.1%. So the dollar has been strong. I kind of think that the story, I think, is really threefold. First, it really goes back to the end of September. Fed cut rates 50 basis points. Interest rates began to rise. The dollar began to rise in late September. And then we had in early October that jobs report, which was stronger than expected. So we had the Fed, sort of the position adjusting after the Fed's 50 basis point cut. Then we get the jobs data, and that's fueling higher U.S. interest rates and a stronger U.S. dollar. But then the narrative changed. And somewhere around the middle of the month or so, it looked like the U.S. election sort of took over as a dominant narrative. And the ironic thing, I think we might have talked about this before as well, is that back in July and August when the dollar was selling off, the narrative was Trump and Vance both were going to talk the dollar down, the high tariffs were going to be bad, so let's sell the dollar. And then what's happened though subsequently is, I'd say beginning in the middle of October, some of the opinion polls and betting markets began showing Trump ahead or Harris losing momentum. And the market concluded that in some of these large pools of capital uh, were arguing that maybe it doesn't make much of a difference who wins, that both candidates were not really going to address the budget deficit, which means there's going to be a greater supply of treasuries, which means higher inflation. So the argument goes more supply, higher yield. So basically, the trade then was selling U.S. treasuries, buying non-treasury things like gold, which made a new record high, buying crypto, buying the U.S. dollar. And I think that's sort of what's happening. Here we are on the eve of the election. It's really a question then of market positioning. And I think that there's several things that could have, if the market wanted to break the dollar back down. I think there's technical levels we went through, the economic data all justified it. The sharp sell-off in stocks on Thursday. But I think that how firm, how resilient the dollar is, I think that the market is not yet sort of a capitulation trade. So that warns me that rates are probably going to go up a bit further, even if, I mean, back in 2016, I think Trump's victory was a surprise to many people. This time, it'll be less of a surprise if he wins. And so, of course, we could be vulnerable to buy the rumor, buy the dollar on the rumor of Trump's victory, buy stocks on the rumor of Trump's victory, and then sell them afterwards. I'm just not sure how far that goes. And again, part of the challenge this time is that maybe, just given how close the election is, we won't know the results right away. So a lot of uncertainty, which means a lot of volatility in the markets.
Yeah, everyone's saying that we're not going to get the election result right away, if not even in the near term after the election. Boy, oh boy. I'm kind of looking forward to having this election behind us, Mark, but let's look to next week because it is the election. It is the Fed meeting, along with a handful of other G10 central banks meeting. Take us through outside of the election because, look, we have all talked about it. We all know it's coming on Tuesday, and everyone thinks that we're not even going to have a result on that Tuesday. Talk to us about the central bank meetings and what we need to be focused on.
Yeah, sure. But just one little last tip, though, about the U.S. election. I'd say at the risk of oversimplifying, I think it comes down to two states. If Harris wins Pennsylvania, she's likely to become the next president. If Trump carries Michigan, he's likely to win the election. So very much up in the air. And just at the risk, like I say, of oversimplifying, maybe if people like me get inundated with all these kind of stuff, I think just focusing on two of the key states. So next week, besides the Federal Reserve, which is going to most likely cut rates 25 basis points, we have several other central banks. In fact, 5 of the G10 central banks meet. So we've got, and I thought the whole range is going to happen. So for example, the Federal Reserve and the Bank of England are most likely to going to cut 25 basis points next week. That'll continue. Both central banks have already begun the easing cycle. After those two, we get the Reserve Bank of Australia, and the RBA is going to be on hold. The RBA has really pushed back against speculation they're going to cut interest rates. The market now does not have the first RBA rate cut fully discounted until the second quarter of next year. I think this overdoes it a little bit. I think it'll come back into the first quarter, but at least for next week's meeting, RBA on hold. That brings us to the two Scandinavian central banks that meet, and they're going in opposite directions. Norway, like the RBA, is not planning on cutting interest rates. They're on hold, and that's what they signaled, and for good reason. Price pressure is still firm, and the economy still seems to be growing well. The weakness has been on the krone, which and the Norwegian krone is really the second weakest currency. And this is the irony: is that here you got the Bank of Japan, which has raised interest rates this year, has not cut them, has the weakest currency. Norway has the second weakest currency, almost as weak as the yen. They haven't cut interest rates either. The people that have cut interest rates have stronger currencies. One, for example, is Sweden. Sweden has cut rates 3 times for 75 basis points this year. The economy has contracted for 3 consecutive quarters. So when they meet next week, unlike Norway, which is going to be on hold, Sweden is likely to be join the chorus of central banks that are cutting by 50 basis points. Remember, the Fed cut by 50, New Zealand cut by 50, Canada cut by 50, and next week it looks like Sweden's going to cut by 50 basis points. They're rounding out the 5 central banks, G10 central banks that meet next week.
So overall, look, we're still getting rate cuts, and we'll see if the Fed cuts rates. I know a lot of people are saying they're not going to because of the election, but as you pointed out, the market is pricing in 100% odds of a 25 basis point cut. Man, it's going to be busy next week. I look forward to catching up with you at the end of the week here, Mark, and recapping what the market moves are and what some of the really results are from central bank meetings as well as the election. And there's also a China meeting next week as well. So a lot for us to talk about next week. Mark, great having you on the show. Again, Marc Chandler, managing partner at Bannockburn Global ForEx, also editor of the Mark to Market website. Mark, thanks for your time.
Thanks. Good luck to everybody.